Hi, this is Alan Gassman, and we are here to support the Kettering Health Foundation to talk to you about the live seminar near Dayton, Ohio, coming up next year, and in particular, to hear the wisdom of Jonathan Blottmacher and Marty Shinkman in 30 minutes or less. So welcome to December 15th. We have Rick Thie, who is the leader of the foundation, the Kettering Health Foundation. Rick, do you want to just tell us for 1 minute what you have in store for us?
Yeah, so we are going to continue these great conversations that you've been experiencing over the past several months in May live, and with Jonathan and Alan present. We've invited Jerry Hesh to be part of that conversation as well. And we're still building out our speakers platforms as we speak. And we'll look forward to having you all come to Dayton and visit us. We're also working on a digital option as well. But if you come to Dayton and you visit us, you get a chance to experience the birthplace of aviation, as well as many other things here in town, as Dayton was really the Silicon Valley of the early 20th century. I guess that's what you could call it. So I'll let it go with that, Alan, and let you guys get on to the topics everybody wants to hear about. But we're really happy to have your support for this effort to help us advance our healing ministry here in Kettering, Ohio.
Go, Marty.
So we're going to get started on slide 57 because in 30 minutes we realized it would be way too fast covering all the material. So we're going to cover less material and hopefully not be quite as pressured about it. So one of the things that everyone knows is that in 2026 the exemption is going to be cut by half. And we all know from what happened in 2012 where clients waited to probably October of 2012, the exemption was supposed to go down from 5 million to 1 million in 2013. And most clients waited to way late in 2012 before they did anything, and we were all slammed in late 2012. We know that in 26, the exemption's to be cut in half, and if we can convince clients to start planning now, even now, before year end, we can do a lot of things that will help enhance the planning clients do and get them a better result. So why do you need to start that 2026 planning now? Jonathan, one of the things that concerns me, and there's been so much talk about the reciprocal trust doctrine, but let's not come to that yet. Why is it beneficial if my wife and I have assets in joint name, and let's say my wife is going to set up a SLAT in 2023 for me, and maybe I'll wait till 2024 because I think we have time. Why would I want to divide assets now? Let's say the assets are all in my name, and she's going to fund a SLAT next year. Why would I want to transfer assets before year end into her name rather than wait? Why is this a unique sort of year end planning consideration?
Well, there are two reasons, Marty. One is you want to get your gifts going as early as you possibly can because of income and growth on those assets. That's just a fundamental factor about giving. Number two, you don't have to worry about doing your SLATs in the same year, which is kind of scary. We won't get into detail under the reciprocal trust doctrine. And the reciprocal trust doctrine doesn't just apply for tax purposes. It was developed for creditor rights purposes. So if I created a trust for Alan and Alan created a trust for me and a creditor sues me and I say, no, you can't have the assets in that trust because Alan created it. Well, the courts didn't have too much trouble in saying, no, these trusts were created basically in exchange for each other. So you want to do that. In addition, you have to worry about law changes. Although it seems very unlikely that you're going to have significant law changes in 2023, there will be some. Mark my words, there will be some. And we don't know what they'll be. But at least if you do something this year, you can basically don't have to worry about that. And you've got 9 months in order to, if you set it up correctly, for the beneficiary to disclaim the interest in the trust and have it all go back to the transferor. So it's easier to do it and you have more time to think about it. But those are some of the reasons, Marty, why I think you really need to start thinking about it today.
Let me expand on yet another reason. So we've all focused on the reciprocal trust doctrine and trying to differentiate slats by doing them in different time periods or with a long time span between them. In 2020 and 2021, contrary to some of the articles that some of our colleagues have unfortunately written, we had no choice but to do planning very quickly, because with the Sanders and Pascrell and Von Holland tax proposals, the law could have changed the next day. And we were just scrambling to get stuff done. I believe clients were aware, as were we, that, it's certainly preferable not to do slats close in time or on the same day, but we didn't have a choice because the pressure was created by Congress, not by us. But there's another opportunity we have right now before this year end to act. And what is that opportunity? The Smaldino case was a classic step transaction case where husband put assets, real estate LLC interest in wife's name. She held them for one day, one short day, and then transferred them into an irrevocable trust. If you have assets for clients that are planning and thinking about and talking about planning before 2026, it can be very advantageous, I think, to start dividing those assets now. What do I mean? I have assets in my name. My wife's going to set up a slat for me next year. Maybe I agree with Jonathan, better to do it now, but let's say we don't have the time to get it done the way we want this year. She'll set it up in January or February as soon as we get around to it. I like the idea of my putting assets in her name today before year end. So it's a different tax year. The income is reported under her Social Security number this year between the stub period of the date of the gift to the end of the year. Ideally, she should use the opportunity and the time, because there's no pressure, to change the assets and show that she has exercised some control over them. If it's a real estate LLC, get distributions made, sign a new operating agreement, renegotiate a lease with a major anchor tenant. If it's marketable securities, which is really the asset of many of our clients, if I transfer assets to her today, she could sign a new investment policy statement, change up the investment allocation, and show that she's had control and exercise control, dominion over those assets. So in contrast to the planning that's gone on for many years, and in somewhat contrast to all the focus on the reciprocal trust doctrine, the Smaldino case, which I think came out in the waning days of 2020, so it's a pretty recent case, we should try to divide and change title to assets before the end of this year. All it takes is contacting a financial advisor and ACATing securities, or calling your corporate attorney and doing an assignment of an LLC interest. Get some of that done this year. Another point to think about.
But Marty, let me break in here about the Smaldino case. They really couldn't have done it worse. As Marty said, Mr. Smaldino gave assets to his wife. She held them for one day, but she was never listed as an owner of those assets. The books and records didn't reflect that. She never got a distribution. And she, of course, put it in trust for his children. So, I mean, the facts were just horrible.
I think that in lines with Smaldino, what Jonathan just said is another great point, and why I'm saying if you can get the first step of the ultimate planning done this year, if it's an LLC with a family business or real estate holding, and I give it to my wife, or if it's in joint name, we divide it, there's going to be a K-1 under the donee spouse's Social Security number for the stub period this year, rather than just starting next year. There's just something that we as tax folks, and I don't know if it's even logical, but I've always felt this way, and I think most of us, if not all of us, feel this way. Just something better having a year-end intervening to break the step transaction doctrine. So I think this is different than all the prior year ends for many years. And if we can reach out to clients that are looking to do planning and get the spousal juggling, rejuggling of assets done this year, I think it's a great step, a different spin on year-end planning that I think can be helpful to help break this step transaction doctrine. Now, the other couple of quick comments. Most people, I don't think, really document much, other than if it's an assignment of an entity. But if it's securities, people tend not to document transfers between spouses. I like doing a gift letter, even if it's a simple document. So I have another piece of paper showing when the gift was made and that the transfer was intended as a gift with no strings attached. I also like the idea of reporting these interspousal gifts on a gift tax return. So if I gave assets from myself to my wife so that they start to percolate and age in her name. I would write a gift letter. I would make that transfer, let's say, of marketable securities. I would also have make a gift of, let's say, to Alan, my good buddy. I'm going to give Alan 20 grand just because he's so good looking. And that way I have to file a gift tax return. And gee, if I'm already filing a return, why not report the spousal retitling? It's not required. The only spousal gift you have to report is if you're electing Q-tip treatment. But now why not report it and go on record and have the statute toll on that interspousal gift? It's a good way to formally document that it was done.
The other thing that you probably want to consider is, how can we undo this? And one way is your spouse could, of course, disclaim it, but not if your spouse has accepted it. And in some states, you can transfer it to a trust and the trustee can disclaim it and have it go back to the grantor of that trust. So you've got a lot of options and make your clients feel much more comfortable in making transfers. And again, although you're not required to report a gift that you make to your U.S. citizen spouse, it's
Right.
always a good idea to, so you show that you actually had the transfer made, you've recorded it, and that is going to be very good evidence if the IRS ever comes in and says, well, you really didn't give it to your spouse. Your spouse had agreed that he or she would do whatever you wanted to do with the property.
And that's, as Jonathan said earlier, one of the lessons of the Smaldino case. They did pretty much almost anything you could think of wrong. So why not go the opposite way and try to document it in as many ways as you can? Transfers between spouses are so easy to do that they just get treated often, I think in most cases, with just not a lot of formality. And a little bit of formality can go a long way to demonstrate what was done. Quick other comment. Let's say clients want to make some transfers before year end. 100% agree with Jonathan. I think it's highly unlikely Congress is going to change the law, but you don't know. No one can predict what what kind of negotiations go on in some back room in Congress. If a client is looking to do a trust, why not get a slat done this year if you can? There's still certainly time, especially if you have a draft trust or an existing trust in process. So then the question becomes, which on slide 60, I just want to address real quickly. What if you can't get an appraisal in time? I don't think if you haven't contacted an appraisal and have the work in process for a while already, you're not getting an appraisal. That doesn't have to stop you from doing it. So I'm going to just give you one concept. Jonathan will probably comment and perhaps even disagree, but just to give you thoughts to have in your little toolkit. So let's say you make a sale to a trust of an interest that you just had appraised, or is in the process of getting appraised, and you can't get the appraisal. The normal application of the king price adjustment is I sell an asset, 25% of an LLC that I think is worth 10 million to a trust. The trust gives me a note for the 10 million face. If there's a gift tax valuation adjustment, the note value will get adjusted, the face of the note upward, so that there's no gift component. What if you make a two-tier king? I'm going to sell these assets to the trust. We believe, but we haven't gotten an appraisal yet, that it's worth 10 million. Adjustment number one to the face value of the note, up or down, is when we get the appraisal from Empire, Stout Reese's, whoever we're using, and I would name them if you can, so it shows that it's real. When we get that appraisal, which we're anticipating soon, we will adjust the face of the note up or down based on that MPI appraisal, whichever company you use. And then the second adjustment factor you build into the note is the standard king price adjustment. Now, Jonathan will tell you, if I gave him enough time, that it's only a 10th Circuit case. It's not a tax court case. Why would you do it? But I don't want to get in. I'm just trying to give you some tools that if you want to get a deal done before year end and you can't get an appraisal, there's still reasonable ways to address it. And this all goes back to Jonathan's comment, which I agree with. Better to get it done sooner. You never know what could come out of Congress, right? You never know. And by the way, why not get it out of your name? Because if there's a bump in value, right, if there's an event that bumps the value significantly, you've gotten your planning done.
Well, let me make a couple of comments here. Number one, you don't have to wait for an appraisal. You can give something away and get an appraisal later. You only have to have the appraisal ready by the time you file your gift tax return. The other thing, and I have used this quite a bit, is the famous Wandry case, W-A-N-D-R-Y, where the tax court unanimously stated that you could have the amount of the gift be determined by its assigned value. So rather than saying I'm giving 25%, of this partnership to my wife's slat or whomever you're getting it. Remember, the slat isn't going to qualify for the marital deduction. So you have to be concerned about value. But what you can do is to say, I'm not giving 25%. I'm giving that fractional share of this limited partnership interest, the numerator of which is, let's say, $10 million or $5 million or whatever my remaining gift tax exemption is. And the denominator is the fair market value of the property today. And again, the United States Internal Revenue Service hates these laundry clauses, but the tax court unanimously approved them. And I think that is a way you should consider going.
Just another couple of quick comments. Let's say you decide you want to get a deal done before year end, which I think is a great idea if you can do it. Some other shortcuts you might do. So and I think Jonathan's in the same view. I'm not sure if Alan is or not, but I like to put all of my trusts wherever possible in a DAPT jurisdiction. I think it's just safer, smarter, better. That's another discussion. But if you're trying to get something done by year end and you can't get an opinion of local counsel, get a trust company review, you could set up a trust in your home state, name Uncle Joe or Aunt Jane a trustee, and get it done quickly, and then have a trust protector move the trust next year to a DAPT jurisdiction. Now, obviously, one of the issues of that is that it doesn't have those protections during the stub period. You may have a shorter statute of rule against perpetuities in the home state, et cetera, but it's just a way to get stuff done. You could use a joinder agreement instead of amending and restating an agreement. You can use a further assurance clause. There's ways you can get stuff done. Jonathan, let me just throw it to you quickly because I'm trying to be mindful of the unfairly short amount of time Alan gave us. And I tried to negotiate an extension and got nowhere. Just briefly, why is it worth doing whatever steps in a slat plan this year that you can to break it up into multiple years?
Well, Marty,
it's the reciprocal trust doctrine issue.
Well, these are reciprocal trust doctrine issues, both for creditors and for the Internal Revenue Service. And you just don't want to have your transactions close together. You want to use different assets. You want to use different trustees. You want to use different controlling jurisdictions. I would hesitate creating a trust in your home jurisdiction. Let's say it's New York or California, where they have very, very bad laws when it comes to creditor rights. In other words, you may not get the protection that you want. So you need to think about that, but almost certainly you could get it done. And if you have something like an asset in the jurisdiction, let's say you want Alaska, or you want South Dakota, or you want New Hampshire, have an asset there, and that probably will give you a sufficient nexus or connection to that jurisdiction that you can have its law control it. And maybe later you do what Marty suggests, you change trustees, you add different things, but you want to start on this now. And one of the factors that Marty has down here is that you want to use different assets, you want to use different trust protectors and everything else, and you want to be able to ensure that you are keeping in mind that if you create a trust for your spouse, it is almost certainly going to be a grantor trust with respect to you. And although I'm sure everybody in the audience has never personally experienced a divorce, there are some people who do. And can you imagine you've created this trust for the benefit of your spouse, you get divorced, and you're told by your lawyer or accountant, guess what? You have to continue to pay the income taxes on the income which is now going to your spouse or is being held for your spouse under section 682 of the Internal Revenue Code. Make sure you do one of two things in every slat you do. And I've been yelled at by spouses saying, how can you possibly define my husband's wife as the woman to whom he's married at the time in question? One of the reasons you tell him that is so he will still have access. So it's not that we don't trust you, we think you may run away from the marriage. That's one thing. The second thing is that you can also put in that if there is a divorce, then the trustee can make a distribution to the spouse beneficiary only with the consent of an adverse party within the meaning of section 672. That way, if the couple breaks up and say the wife says, the last thing I want to do is to continue to pay income taxes on this trust that's for my husband. Well, guess what? You're going to have your best friend in there as trustee, and you can be assured that that trustee is not going to make a distribution to your now ex-spouse unless it's with the consent of an adverse party. And that will keep it from that time on from being a grantor trust.
So we're going to jump to year-end gifts, annual gift exclusion gifts, because that's a critical year-end topic. And I think that one of the key take-home points that we want to make on this is it's not one size fits all. It's not the same standard answer. And if any of you work in the accounting profession, you know who Sally is. For those that aren't accountants, Sally means same as last year. I remember embarrassing myself when I was at Coopers and Lybrand 40 plus years ago, when I went over to the senior who had like a year longer on the job than me and said, "Who's Sally? Where is she?" And everybody laughed at me and then explained to me what Sally is. Too often annual gifts are approached with a Sally perspective. Well, that's what we've always done. We need to disrupt that pattern and talk to clients about what really should be done with annual gifts and why. Jonathan, you want to make some comments on annual gifts, and then I'll chime in after you've said whatever you'd like to say.
Right. The annual exclusion this year is $16,000. It's going up to $17,000 next year. Now, I always make gifts to my children, but I back it off from the, say, $16,000 this year because I do buy holiday presents and birthday presents for my kids, and we take them on trips. So, you know, I cut it down from $16,000 to either $13,000 or $14,000. And that's something that you really should be considering. You don't want to go over. And I report those gifts. Now, I typically make them to crummy trusts, and we can talk about that in a moment. But you can also give unlimited amounts away for your children's health and education if it's directly provided to the educational unit or the healthcare provider. And as Marty has down, if you want to go into a 529 plan to provide for education, you can give 5 years worth of annual exclusions right now. So if you say, well, I'm going to wait till next year and then I'm going to give $16,000 times 5, you could give $80,000 and put it in there. And of course, with a 529 plan, you can actually change the beneficiary. So that's something that you might want to do, and that makes an awful lot of sense. And one of the things is you can give away so much money under the protection of the annual exclusion. Your clients need to do it. And one of the things that you can do, and Dick Covey showed this, mentioned this after the Alaska Trust Act passed, which allowed you to create a trust for yourself. He said, why don't you do a crummy trust for your descendants, but make yourself an eligible beneficiary? Therefore, you can use the annual exclusion, but if you need it, the trustee can benefit you if you're in Alaska. And now, of course, there are 18 jurisdictions where you can do that. So, you know, I'm not talking about 529 gifts now. I'm just talking about making annual exclusion gifts. But if you go ahead and you have, say, 2 kids, or your client has 2 kids, and they have 2 spouses, and they have, say, 2 kids each, that's a total of, is that 8, Marty? Is my math correct that there are now 8?
I didn't bring a calculator to
well, I think it's 8 donees. So it's 8 times, you know, it's 8 times 16,000. Plus, if you're married, your spouse can split. It's now 16 times 16,000. And you can get a tremendous amount out of your name. Now, you know, you might say, well, wait a second. You said I have in-laws. Why am I going to do something with that? Well, one of the best trusts I've ever come up with, and Alan and Marty, I'm not sure you're even aware of this, it's called the Extra Crummy Trust. And it's where you make annual exclusion gifts through a crummy trust, a trust that allows the annual exclusion to apply because people have the right to withdraw assets from the trust for a while, and then it lapses. That appeared in the July-August issue of Probate and Property in 2008. If anybody wants it, you can go ahead and drop me a note and I will send you a copy. It is the best annual exclusion vehicle around. And one of the benefits of it, you do one trust for your client one time. They don't have to come back. And it will expand as you have more descendants. It will contract if someone has died. It can cover a new spouse rather than your child's current spouse if there's a divorce or a death and a remarriage. and you only have to do one trust for the family, and I think they'll love that. But every year they can put in what they want, have it covered by the annual exclusion, and over, you know, a relatively short period of time, say 10 years of making these gifts, you will be getting millions of dollars out of your client's estate. And again, if you do it in a self-settled trust jurisdiction, you can, by and large, except with respect to grandchildren, you're going to be able to be a beneficiary of the trust yourself. It really is something worth looking at.
So let me raise a different perspective that I think is important to talk about. We live in a very different tax time than when most of these trusts were set up. Lots of our clients have trusts that they set up long ago for children, grandchildren, insurance trusts, lots of insurance, old style insurance trusts out there. And all those trusts were patterned on the concept of, let me use annual exclusion gifts to shift money out of my estate. Many of those trusts were set up when we had a $600,000 or $1 million exemption, and we needed those. The way Jonathan went through some math, if you could move $50, $100, $200,000 a year out of your estate, and the exemption was only $1 million, that crummy power trust, those annual gifts were a huge component of the planning, and over many years would transfer more wealth than the exemption. Things have changed radically. Right now in 2023, the exemption is close to $13 million. For a large swath of clients, they don't need to make annual gifts in order to avoid estate taxation. They don't need it, and it's a pain in the neck. And I'm not going to speculate, in case this is being recorded, what percentage of clients actually do their crummy powers properly, right? I'm not going to comment further on that. But instead of
Marty, let me mention that the tax court says you do not have to give notices. And
I think that was the Turner case?
Yes, that's the Turner case. Now, you know, you can go ahead and do it, but I know from practical experience, giving crummy notices is rarely done in cases. No one sits down and says, oh, we paid another life insurance premium. Oh, we added another $10,000 to the trust. Let's send out crummy letters. It's a pain in the neck. And I believe that the IRS did it to prevent you or discourage you from doing annual exclusion gifts.
So the point is, under the current environment, a lot of, and I apologize for the term moderate wealth, but moderate relative to a $13 million exemption, that could mean clients worth $30, $40 million and less should rethink, with our help, whether they should continue this ritual of annual gifts. Some clients like it. I've had clients that love to hand out those checks at Christmas time and the Christmas cards. They want to do it for personal reasons. But a lot of clients have been doing it because of Sally, same as last year. We should rethink that. It may be a lot smarter and better to make a large gift of $500,000 to an insurance trust, pre-funding all future likely insurance premiums and moving money into the trust, have an investment account set up for the trust, file a gift tax return, and be done forever more with doing annual gifts and the crummy powers that often don't get done. I think we need to help clients rethink that. For a lot of clients, annual gifts is not a ritual that really makes sense for them, and especially given the risk, because it is often not handled correctly. And one of the other reasons it's not handled correctly is, as Jonathan said earlier, he backs off from the 16,000. I would say the vast majority of clients, I have no statistics to support it, but my belief is the vast majority of clients that write out checks do it for the 16 grand, and they don't count the holiday gifts and the birthday gifts and the cruise trips they take the kids on. So keep in mind that we should revisit that. Now, in revisiting that, we have to be mindful. For some clients that have used up their exemption and have 30 or 40 different beneficiaries, you can move massive wealth still in the current environment, and the annual gifts make a lot of sense. There's another concept. Let's evaluate all these old insurance trusts and see what else should be done with them. In some cases, these old life insurance trusts, it's not only a question of the crummy powers. Maybe when you make that large gift, you do a late allocation of GST and then decant it into a better crafted trust. A lot of the old ILITs that are out there, lots of them, because we see them come in all the time, you know, pay everything out to the kids at, say, age 30. What a waste of exemption and asset protection and divorce protection. Decant it into a modern trust, make a modern gift, GST allocation, and you've got a great plan. So I think it's important when we approach year-end planning to rethink the traditional annual gift. For some people, it's phenomenal. For other people, not so.
Well, let me also mention in the waning seconds we have here, it's a good idea, and I do this myself, to report the annual exclusion gifts. But keep in mind, you don't have to. You still get the benefit of the annual exclusion. Of course, by disclosing what you've done, you're going to get the statute of limitation to run where the IRS can't come in and say it was really something else. You've now disguised it. But keep in mind one other factor. If you're going to make gifts to grandchildren, you not only have to worry about the annual exclusion, you have to worry about generation skipping transfer taxation. Now, if you give something directly to a grandchild, for example, you can go ahead and get basically the generation skipping annual exclusion as well. But if you're going to put it in trust and where you're dealing with significant amounts of money, Alan, Marty, and I are in complete agreement you ought to do it in trust. Keep in mind that you may have to file a return and allocate GST exemption unless you're making it to a GST trust, which is a defined term under section 2632. And if you make a gift to a GST trust, you will have the GST exemption automatically allocated to that trust. You don't have to file a return if you don't want to, but it's always a good idea to do it, especially when you're talking about big amounts of money. Keep in mind, if you've got 8 donees, you've got 2 kids, they're each married, so that's 4. And you've got, between the 2 couples, your son and his wife and the daughter and her husband, you've got a total of 8 donees, and you can give away $256,000 every year. In 4 years, you've given away more than $1 million, and it's all going to be covered by the annual exclusion, but you want to make sure that you're okay in allocating GST exemption to it. The exemption for GST will be automatically allocated if it's a GST trust, which means it's a trust for the grandchildren. And even if others, for example, have crummy powers of withdrawal, it's all okay, provided the crummy power of withdrawal doesn't exceed the amount of the annual exclusion.
One quick comment on charitable giving, because I know we're out of time. There have been a number of court cases where taxpayers have got dinged and lost large charitable contribution deductions because they haven't had the right paperwork. Some of the slides, which we're not going to get to, talk about some of those cases. I just bring it up because we all have clients doing year-end charitable giving. Make sure you get the paperwork right. Dig out the instructions, see what the regs, see what the IRS requires, make sure it's done right. You don't want to lose a big deduction on a mere technicality. Alan, I think we're out of time.
You guys did great. Thank you so much.
Can we get another 60 minutes? Another 60?
Yeah, in Dayton, Ohio, we'll have all the time we need. Well, thank you guys so much. That was a wonderful presentation. I picked up some things I hadn't thought about, and I'm sure that others did as well. We'll be seeing you monthly for the Ketterling system. Thanks to Rick Thie for hosting us, and have a fantastic rest of your day.
Thank you, Alan.
Thanks, everybody.
Thank you, Alan. Yeah.